Is gold suffering from an identity crisis? Peter Hug joins us next. Joining me now to help make sense of this price drop gold is facing is Peter Hug. Pete, thanks for being with me.
You're welcome.
So Peter, I want to start by going over a laundry list with you here. 1, we have a weak US dollar. 2, we're nearing the edge of the famed fiscal cliff. 3, the US is about to reach its debt ceiling in 8 weeks' time. And 4, this should traditionally be a good time for physical demand, yet gold is not performing as it should. Why?
Well, I've been in the camp for the longest time suggesting that no solution on the fiscal cliff is going to be negative for the metals. And with the fear capital running into cash, as people get concerned that there won't be a resolution to the fiscal cliff by year end. I underestimated the obstinance of the politicians in Washington in not coming to an agreement. As you know, we've been out of this market since 34.50 in silver. And I actually entered the market yesterday at 32.78 basis on the March contract. The trade looked really good overnight with silver moving back up to 33.30, but it's again hovering around that the 32.78 range now. I've got a tight stop in there at 32.45, which means silver would have to break 32.50 triple support bottom. I'm still constructed this market. The other thing we need to look at is that a lot of the big fund managers throughout 2012 missed the equity move and have dismal performances in their funds. One of the few things that they made money on were the precious metals, and so it's not uncommon that some of them would be taking some of the money off the table before year end, not only from a point of view of locking in their profits, but also possibly locking in lower tax rates if they do believe we're going over the fiscal cliff in January.
So Peter, let's just hold that fiscal cliff thought for a second. Let me ask you this. In a nutshell, drama tends to be good for gold if I really have to water it down. So why, if we were to go over the fiscal cliff, it wouldn't necessarily be good news for gold? I know you've told me this offline. What's your theory behind that?
I qualified that statement by saying it wouldn't necessarily be good for gold in the short term. Every time there's been a major crisis in the market, even when we had this issue last summer, when we were having the issue with the debt recalibration in the United States on the debt ceiling, the first reaction on the metals when there is a major sell-off in general asset classes is that metals will go down, because the first impulse of an investor is that they want to hold on to their positions. And if they're holding on to equity positions or bond positions, if they're moving against them, they either tend to want to average down on those positions or they tend to want to meet margin. In that instance, you need liquidity. And what tends to happen, the first knee-jerk reaction is they sell what's liquid, which happens to be the metals. So you get a down move in the metals first as the liquidity is generated. And then when you analyze the situation and you understand the ramifications of what has just happened, the money moves back into the metals, and then you get the upward move.
So, Peter, do you think gold's just suffering a little identity crisis right now? Are people not viewing it as a safe haven?
As a trader, there's been just incredible opportunities to make money in this market over the past 6 months. A $2 down move in silver, had you sold resistance at 34.50 and entered the market even this morning when it hit 32.50, which was a triple bottom support. There's a lot of money to be made in this market if you're trading. You have to be disciplined. You have to put in your stop losses. For the longer term investor, I see absolutely nothing that has changed. There was a bank out this morning. Their name is irrelevant because I usually don't listen to bankers, that indicated that, gold has now finished its cycle, and there's going to be major growth in the United States next year. And that's going to create a situation where the gold market is going to go down. In theory, I agree with the premise, but I think they're way, way premature on their forecast. I don't see 5-6% growth in GDP next year. I think we'll be lucky to have 2% in the United States. I think the Fed will continue to be accommodative. And until that changes, I think the uptrend in gold is intact. But when that does change, and we do have a strong economic recovery, which will require higher interest rates to stave off inflation, that'll be the end of the gold cycle, and then we'll see progressively lower highs and lower lows. But I still think that's a year to 2 years away.
Peter, just a quick question on silver here. Some people I've been speaking with have said that at these price levels, they've been shorting it lately. Is that a good play here?
Silver scares me. It hit my target early at 34.50. But silver, if you look at silver right now, I mean, in my opinion, it should be lower relative to where gold has dropped. And every time we come to a support level, there seems to be fairly significant buying for silver. I'm watching the stock market relative silver. As long as this stock market doesn't tank and it can just hold this level or even move up on a Christmas rally, which is still possible in my mind, I still like silver more than gold at these levels.
All right, Peter, let's look at the bigger picture. Gold futures are still up 8% for the whole year. Also, Goldman Sachs projecting today, Wednesday, 18.25 gold as an average price within the next 3 months. I know you are looking at 18.25 gold by year end. You're generally optimistic, right?
Well, it depends how you define optimism. If my theory is right that gold is 18.25 at year end and then considerably higher next year, yes. If you're purely in the gold market, I would call that optimistic. But when that happens, that's going to result in many other things that are going to be very, very detrimental to the investors and consumers in general. That's the ironic part of our business. We're rooting for gold to go higher, but that's usually on the back of issues in other areas of our lives and in the economy.
Peter, let me ask you this. Do you think that part of the problem is we're not seeing new buyers of gold emerge? Is it universally understood by investors?
I think gold, I think most investors have been relatively educated on the gold price. Commodities in general tend to require volatility. When you trade in a range for a sustained period of time, you've usually dried the market up of the buyers and the sellers within that range. You'll get the specs to try to push through the range on either side, which will create a flurry for a bit. But yeah, these levels have been seen. We saw them all last year. We've been trading in these types of ranges for the better part of this year. So, these ranges, in my opinion, are somewhat dried up. If we get over 18.25, I think a whole new enthusiasm will enter the market. And I ironically also believe if gold breaks down through 1,500, there's going to be another surge of enthusiasm from clients that missed the first run and also from clients that are looking to sell. So I think these markets will continue to be volatile with an upward bias again for the next 1 to 2 years.
Excellent, Peter. Thank you for your thoughts this week.
Okay, you're welcome.
And thanks for watching this installment of For Pete's Sake. You can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Camboni. Thanks for watching.